For most of my career, I've been what many would call a traditional banker. I built JPMorgan Chase into the largest bank in America through disciplined lending, risk management, and serving clients through physical branches. But after 4 decades in this business, I'm telling you something that might surprise people. Fintech companies are going to dominate the financial services landscape over the next decade. At JPMorgan Chase, managing over $3.7 trillion in assets and serving 60 million households, we have an unparalleled view of how financial services are evolving. What I'm seeing is the most fundamental transformation of banking since the Federal Reserve's creation over a century ago. For years, I was skeptical about fintech disruption. I watched companies burn through billions trying to reinvent banking without understanding regulation or sustainable business models. Many failed or were acquired for fractions of their peak valuations, but something has changed. The fintech companies that survived have matured, developed sustainable business models, learned regulatory navigation, and proven they can deliver financial services more efficiently and conveniently than traditional banks. At JPMorgan, we've invested over $15 billion annually in technology, and through this investment, I've gained deep appreciation for what the best fintech companies accomplish. The first major trend driving fintech dominance is complete digitization of financial services and demographic shift toward digital native consumers. Every year, millions of new consumers enter financial services who expect instant gratification and want to manage their entire financial lives through mobile applications. They don't want bank branches, lines, paper forms, or traditional banking bureaucracy. At JPMorgan, our data shows over 90% of routine transactions now occur through digital channels. Mobile banking usage has grown 30% annually for 5 years. Our youngest customers interact almost exclusively through digital platforms, visiting branches less than once annually. This creates enormous advantages for companies built for digital delivery. Traditional banks spend decades building branch networks that become less relevant yearly, creating structural cost disadvantages. Fintech companies deliver services at marginal costs approaching zero for many transactions, while traditional payments require expensive infrastructure. The user experience advantage is even more significant. Fintech companies design mobile-first experiences with intuitive interfaces and integrated financial management tools. Traditional banks are constrained by legacy systems designed for branches and awkwardly adapted for digital delivery. The second major trend is artificial intelligence and machine learning transforming financial services in ways that favor fintech innovation. Modern financial services are fundamentally about data analysis, risk assessment, and pattern recognition, areas where AI excels. Fintech companies build platforms from the beginning to leverage machine learning for credit decisions, fraud detection, investment recommendations, and customer service. At JPMorgan, we've invested heavily in AI, including our coin system and proprietary trading algorithms, but we're constrained by legacy systems and regulations that slow innovation. Fintech companies implement AI solutions more quickly without decades of technology debt. AI-powered credit scoring represents significant opportunity. Traditional banks rely on credit scores that disadvantage young consumers and immigrants. Fintech lenders use alternative data, employment history, education, transaction patterns to assess creditworthiness more accurately, serving customers traditional banks reject while offering better rates. Robo-advisors and automated investment management offer sophisticated portfolio management at costs far below traditional wealth management. Fraud detection benefits enormously from AI capabilities, analyzing transaction patterns in real time more effectively than rule-based systems. The third trend driving fintech success is regulatory modernization that increasingly favors innovation over incumbent protection. Banking regulation historically protected established institutions through barriers to entry, but regulators worldwide recognize that innovation and competition benefit consumers and economic growth. Open banking regulations in Europe, Australia, and other markets require traditional banks to share customer data with authorized fintech companies, breaking data monopolies that protected incumbents. Similar regulations are developing in the United States through FedNow and real-time payment systems. Regulatory sandboxes allow fintech companies to test products with relaxed requirements, enabling innovation impossible under traditional banking regulations. Banking as a service regulations let fintech companies partner with smaller banks to offer FDIC-insured products without full banking licenses. The Federal Reserve's development of central bank digital currencies and real-time payment systems creates infrastructure leveling the playing field between traditional banks and fintech companies. The fourth major trend is expansion of fintech services beyond traditional banking into comprehensive financial ecosystems. The most successful fintech companies aren't replicating traditional banking, they're reimagining financial services as integrated platforms addressing all aspects of customers' financial lives. This ecosystem approach creates stronger customer relationships and higher lifetime values than single product banking relationships. Payment companies like Square and Stripe expanded from processing into lending, banking, and business management software. Personal finance companies like Mint evolved into comprehensive platforms offering banking, credit monitoring, tax preparation, and insurance. Cryptocurrency platforms create entirely new categories, including decentralized finance and programmable money that traditional banks cannot offer. Buy now, pay later companies like Affirm created new consumer credit forms integrating with e-commerce platforms. The ecosystem approach creates multiple revenue streams from single customer relationships, higher switching costs, and cross-selling opportunities that traditional banks struggle to match due to organizational silos and legacy systems. The fifth trend is global expansion opportunities that favor fintech companies over traditional banks. International expansion for traditional banks requires enormous capital investments, regulatory approvals, and physical infrastructure. These barriers have limited most banks to domestic markets. Fintech companies can expand internationally through software deployment and partnerships rather than capital-intensive infrastructure. A successful fintech platform can serve customers in dozens of countries with minimal incremental costs once developed. Emerging markets represent particularly attractive opportunities because they often lack developed traditional banking infrastructure. Fintech companies can leapfrog traditional banking by providing mobile-based financial services to previously underserved populations. Cross-border payments and remittances represent massive opportunities where fintech companies have clear advantages. Traditional wire transfers are expensive and slow, while fintech companies offer faster, cheaper transfers using blockchain and alternative networks. Now let me address the investment opportunity in fintech stocks and why they represent compelling value despite recent market volatility. Fintech stocks have experienced significant volatility over the past few years, with many companies trading at substantial discounts to their peak valuations. This volatility has created opportunities for investors who understand the long-term trends driving fintech adoption. The total addressable market for financial services is enormous. Americans spend over $500 billion annually on financial services, while global financial services represent over $20 trillion in annual revenue. Even small market share gains by fintech companies represent billions in potential revenue. Revenue growth rates for leading fintech companies consistently exceed traditional banks by wide margins. While traditional banks typically grow revenues 3% to 5% annually, leading fintech companies grow 30% to 50% annually, with some companies sustaining growth above 100% annually during expansion phases. Profit margins for mature fintech companies often exceed traditional banks because they avoid the high fixed costs of physical infrastructure and can serve customers more efficiently through automated systems. Operating leverage in fintech business models means that growth in transaction volume translates directly to profit growth. Valuation metrics for many fintech companies have compressed significantly from peak levels, creating opportunities to invest in high-growth companies at reasonable prices. Many fintech stocks trade at price-to-sales ratios below traditional banks, despite much higher growth rates and superior profit margins. The competitive moats being developed by leading fintech companies, network effects, data advantages, regulatory approvals, and customer switching costs create barriers to entry that protect long-term profitability and market share. Market consolidation is accelerating as successful fintech companies acquire smaller competitors and traditional financial services companies acquire fintech capabilities. This consolidation creates opportunities for investors in leading fintech companies to benefit from industry transformation. Let me discuss specific subsectors within fintech that offer the most attractive investment opportunities. Digital payments companies represent the largest and most mature segment of the fintech market. Companies like PayPal, Square, and Stripe have established dominant positions in different aspects of the payments ecosystem and benefit from the ongoing shift from cash to digital payments. The global payments market processes over $150 trillion annually, and digital payments are growing at double-digit rates while cash and check usage declines. Payment companies earn small percentages of transaction values, but the enormous transaction volumes and growing market share create substantial revenue opportunities. Payment companies also benefit from network effects. The value of payment platforms increases as more merchants and consumers adopt them, creating competitive advantages that are difficult for new entrants to overcome. Digital lending platforms offer attractive opportunities because they can serve customers more efficiently than traditional banks while using alternative data sources to make better credit decisions. Companies like Lending Club, SoFi, and Affirm have demonstrated sustainable business models with attractive risk-adjusted returns. The lending market is enormous. Americans hold over $4 trillion in consumer debt, and fintech lenders are gaining market share by offering better customer experiences and serving previously underserved segments. Regulatory changes are making it easier for fintech lenders to compete with traditional banks, while economic conditions favor alternative lenders who can adapt quickly to changing market conditions. Personal finance and wealth management platforms represent high-growth opportunities as consumers increasingly want integrated financial management tools. Companies like Robinhood, Betterment, and Personal Capital have attracted millions of users by offering services that traditional brokers and advisors couldn't match. The wealth management market is particularly attractive because it generates recurring revenue through management fees and offers opportunities for expansion into related services like tax preparation, estate planning, and insurance. Cryptocurrency and blockchain companies offer the highest growth potential but also the highest risks. Companies like Coinbase, Block, and MicroStrategy provide exposure to cryptocurrency markets while maintaining more traditional business models and pure cryptocurrency investments. The cryptocurrency market is still developing, but institutional adoption is accelerating and regulatory clarity is improving, creating opportunities for companies that can bridge traditional finance and cryptocurrency markets. Insurance technology companies represent emerging opportunities as traditional insurance companies are slow to adopt new technologies and serve customers digitally. Companies like Lemonade, Root, and Oscar Health are using data analytics and digital distribution to challenge traditional insurance models. Now let me address the risks and challenges facing fintech investments to provide a balanced perspective. Regulatory risk remains significant for fintech companies as changing regulations can dramatically impact business models and profitability. Companies operating in cryptocurrency lending and payments face particular regulatory uncertainty as governments develop new frameworks for these industries. Competition risk is intensifying as traditional financial services companies invest heavily in technology and new fintech companies continue entering the market. The competitive advantages that early fintech companies enjoyed are being challenged by well-funded competitors with greater resources. Economic sensitivity affects many fintech companies more than traditional banks because they often serve higher-risk customer segments and have less diversified revenue streams. Economic downturns can significantly impact lending volumes, payment transaction growth, and customer acquisition. Technology risk is inherent in companies whose business models depend entirely on software platforms and data systems. Cybersecurity threats, system outages, and technology failures can cause significant damage to customer relationships and company valuations. Valuation risk affects many fintech stocks that trade at high multiples based on growth expectations. If growth slows or profit margins disappoint, stock prices can decline significantly as valuation multiples compress. Capital requirements may increase as fintech companies mature and face more stringent regulatory oversight. Companies that currently operate with minimal capital may need to raise significant additional funding to meet future regulatory requirements. Implementation strategy for investing in fintech stocks should emphasize diversification, quality management, and long-term perspectives. Diversification across different fintech subsectors reduces risk while capturing various growth opportunities. A balanced fintech portfolio might include payments companies, lending platforms, wealth management services, and emerging technologies like blockchain. Focus on companies with proven business models, sustainable competitive advantages, and management teams with experience navigating regulatory challenges and competitive pressures. Companies with strong balance sheets and multiple revenue streams are better positioned to survive economic downturns and competitive pressures. Long-term investment horizons are essential because fintech transformation will occur over years or decades rather than months. Short-term volatility is inevitable, but the underlying trends driving fintech adoption are likely to persist regardless of market conditions. Dollar cost averaging into fintech positions can reduce timing risk while building exposure to this high-growth sector. Regular investments allow investors to benefit from volatility while avoiding the challenge of timing market bottoms. At JPMorgan, we're positioning ourselves to benefit from fintech trends rather than fighting them. We've invested billions in technology development, acquired fintech companies, and formed partnerships with innovative companies that complement our traditional banking capabilities. But we also recognize that the best fintech companies will likely outperform traditional banks over the next decade because they have structural advantages that are difficult for established institutions to replicate. These companies represent investment opportunities that investors cannot access through traditional bank stocks. The key insight is that fintech is not just a technology trend, it's a fundamental transformation of how financial services are delivered and consumed. Companies that successfully navigate this transformation will capture enormous market opportunities, while companies that fail to adapt will lose market share and profitability. Your investment success in this sector will depend on identifying fintech companies with sustainable competitive advantages, proven management teams, and business models that can scale profitably while navigating regulatory requirements and competitive pressures. The next decade will be defined by the companies that can combine technological innovation with financial services expertise to serve customers better than traditional approaches. These companies represent some of the most compelling investment opportunities available today for investors who understand the transformation occurring in financial services. Remember that the best investments often exist in sectors experiencing fundamental change, where new companies with better business models can challenge established incumbents. Fintech represents exactly such an opportunity, a massive industry undergoing technological disruption with clear winners emerging that can provide superior returns for informed investors willing to embrace the future of financial services.